I'm Doug MacKenze.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome, everybody.
Good morning.
Morning, John.
Or maybe it's afternoon or evening, whenever you're listening. But yes, to you, Doug, good morning.
Good day.
It is morning.
How's everything going, John?
Yeah, like I mentioned earlier, it's a lot of thinking. A lot of thinking going on. Sometimes I'm trying to quiet that down, but for the most part, things are good. And looking forward to sharing some more today.
Nice. Yeah, we were just going back and forth talking about some things, and we were like, okay, we gotta stop and hit record. So
yeah, that's the best way to do it. You know, we don't really edit anything. We just turn it on and talk, and you can even tell because sometimes there's some sort of delay in my thinking and of what word I'm going to use and all that. We're not trying to make this a perfect, smooth ride, but we'd like to make it as smooth as possible for the listeners. And then it's just having a conversation, and hopefully you're joining in, and please, reach out if you want to, give us thoughts on, what we were talking about. So,
yeah,
thanks.
We're regular guys. We like to try to be authentic that way. But yes, like John said, we have been getting some more questions and some people providing feedback, and we always love that. We like to engage with our listeners. And today we thought we'd talk about something. It's actually a really interesting rider and feature that is offered on a lot of whole life policies. It's called the Premium Deposit Fund rider. And we think that there aren't many people that are aware of what that is and how it can be utilized. So we just wanted to kind of do a little educational piece and walk through that.
Yeah, like so many things, they turn them into acronyms, PDF, Premium Deposit Fund, and, trying to remember it sometimes.
The first time I heard that, I'm like a PDF, like a document? No.
Well, for me, it's, like, what order do I say this in, and, just breaking it down briefly, right? It is a place to deposit. It's a fund to deposit premiums, but they're future premiums. They're not currently owed premium. So we can put it in reserve for future payments that are due. And the company that we do a lot of work with, the insurance company that we do a lot of work with, has a couple different options. One is that you can do up to 2 years worth of premiums in this fund sitting there and actually earning interest, and I'll put interest in quotes. Mm-hmm. But then there's another one that you can put in play that from the outset of your policy, and you can do anywhere from 3 years to 10 years of premiums sitting in there. And
PDF Max.
Yep. And the idea is basically as the years go by in that premium or a PDF Max, Premium Deposit Fund Max, the 3 to 10 years, is that you're putting in a lump sum, and that's a discounted amount. So, for example, and these are all just general numbers, don't hold me to them, but if you were, say, I want to put in $10,000 for 10 years, you wouldn't have to put in 10 times 10 or 100,000. You might only have to put in, 75,000. Mm-hmm. But it would be like the policy was getting the 10,000 every year for 10 years and growing in that way. And so they basically just every year kept giving you a credit, which is like an interest rate, and it will create just like a bank account that has, interest income. They technically give you a 1099 and so it is reportable if that's what you're doing, and then it grows like you were earning that interest. So they're basically earning the interest and then deducting it from what you owe for your premiums. Hopefully that's helpful.
Yeah. I mean, if you're somebody that has a lump sum, but like we've talked about previously, you can't just go throw that lump sum in 1 year or it will mech out, right? And we don't want a modified endowment contract.
Yeah.
And it's valuable for the insurance company. They're offering you a discount on your premium in order to have access to your money, but they're offering you the ability to put your money there and it is going to use. I mean, you're getting the benefit of a much higher premium payment without having to pay that premium payment. Yeah. And it's in a safe spot. And it is a really nice feature for a lot of people in that situation. And then, like John mentioned, the other PDF rider, the one that's more commonly used, that's up to 2 years. I mean, I was actually thinking about using that on one of my policies like a few months ago because I had a bunch of extra cash that I was kind of just sitting there waiting to pay my next year's premium. And it's like, well, why don't I just put it to use there, And it's no cost. The rider's no cost. And the only way that you can kind of lose access to it is if you put money into the rider and then you pull it out. They will give it back to you, but you will then lose access to that rider in the future.
Right. Basically meaning that you cannot use it like a bank account. Like if you put it in motion, you put the money in, say, for 2 years, and then something came up and you said, geez, I want some of that money or I want it all. They basically will give it back to you, but you can't then re-implement it. You can't then, that rider is shut off and you can't say, hey, I've decided I want to put the money back in again and use this premium deposit fund. It's no longer available to you if you do it that way. That's one of the drawbacks. But yeah, you certainly, having it sit in, say, a savings account. Right now, a savings account isn't paying the rates that these insurance companies are paying for these premium deposit funds. So it doesn't make any sense if it's just going to sit there waiting for your next premium in a commercial bank savings account. I mean, obviously, if they're CDs, okay, then it's locked up for some period of time, 6 months, 12 months, whatever. But those will pay more than what a savings account interest rate will be. But most people aren't doing that either. But if you're going to have the premium coming up, say, in the next 6 months,
well, it's also a nice way to just have discipline. Do you know what I mean? I mean, it's for a lot of people, one of the nice things about a whole life insurance contract is that it's forced discipline. It's forced savings, essentially.
Yeah.
And, if you're sitting there with a bunch of cash, most people have a tendency to want to spend that. I know that's always kind of like an itch with me. If I have too much cash, is what should I do with this? I mean, it shouldn't just be sitting there. I got to do something with it. It makes me uncomfortable sometimes.
Right. And
this is a way where you can ensure that it's going to go towards something that is beneficial and useful.
Right. As long as you've determined that from the outset, right?
Yeah.
Which is why you implemented the policy in the first place, an IBC-based type policy, then it's valuable. So like you've said before, I can't wait to get my money in there. So and it's not like you're stowing it away and it's not providing any value to you, which is it's earning this discount or this interest rate. With that said, I'm going to follow my sword, right? I've been indoctrinated by this financial system and this way of thinking, and sometimes, like you said, you end up with money and you kind of like, okay, I am an IBC practitioner and I do own policies on myself. I've got this money. What should I do with it? I mean, you're literally questioning it even as a practitioner. I'm going to, as I said, follow my sword because I'm kicking myself. Even this year, right around the time that we started this podcast, I bought a used car and I had the money.
Steering wheel's on the other side of the car, by the way. Just, yeah. I feel like we need to mention that.
Yeah, it's a rare vehicle that has the steering wheel on the right-hand side here in the U.S.
That's a pretty cool car.
But, it was a version of an American car that was made actually in Japan for Japanese people because it actually speaks Japanese to me. It has Japanese buttons and everything. But, of course, it has the the steering wheel on the right-hand side like cars do in
It
Europe.
throws me off every time I see you.
Yeah, I get a few thumbs up here and there, usually from young gentlemen, like, hey, cool, But, it's been fun because it's different, and of course, I always seem to be different. And so, yeah, it's been fun. But anyways, I had the cash, and I have 2 policies on myself, and they literally, one is due, the premiums are due in July, and one's due in January. It just worked out that way. And I bought this car in May, and I'd already paid, because I already had the money set aside for my July payment, and then I didn't have another payment for, say, 8 months for my other one. And I said, why don't I just buy the car and, when I make another cash flow, I'll be ready to make my payment in January. And I'm kicking myself because I should have put, I'll just say it. I'll say the exact number. I should have put the $20,000 in the premium deposit fund of my policy that's due in January. I would have got a discount. I would have borrowed the money out of one of my policies to buy this used car, and I'd already be set up to pay the minimum on my policy in January. And now that $20,000's gone. And I'm like,
yeah, it's gone from your system. Forever.
People say you shouldn't use these words, but I'm not going to beat myself up totally, but yeah, it's kind of an idiot move, like, geez, and you're a practitioner for gosh sakes, And so what I'm trying to share is, well, that's the benefit of time and practicing and hindsight, and we get to share these stories with you and say, even we got to stop and think, and who do we bounce this off of? Well, I can tell you can bounce that kind of thing off of me now, because I'll tell you, it doesn't feel good. And it just feels like, yeah, I didn't do the right thing, and, hey, next time. But I want to share it with everyone that's listening because, you don't have to go through this. And literally, I'd probably stop and think a little bit more if you came to me and asked me a question, like, what should I do in this situation? And,
well, that was your way of thinking for like probably 55 years.
Yeah.
So it's hard to undo that.
57 to be exact.
50, yeah.
Well,
not
even
that we're counting.
Maybe even 61 years because I just did the wrong thing.
But when we talked about this in the episode with, kind of overcoming ingrained programming, it's difficult when you're used to doing the same thing for so long.
Yeah. To
fortify this new idea in your brain that, hey, that actually doesn't make sense. Even though that's what everyone's telling you to do. Hey, you could buy a car in cash. That's the best thing you can do. That's great,
Yeah.
But really, that $20,000 just flowed out of your system. But it's
literally.
But like I could see myself doing the same thing.
Yeah. And so it took, I feel like we all know sometimes these lessons we learn in life, like we needed to learn them, not only for ourselves, but hopefully so we could share with people that want the insight, that want the the advice on what should we do. And when you live it and then realize, oh, that wasn't what I would do if I had a chance to do it today, it would be almost a no-brainer. Why wasn't it a no-brainer in May when I did it? You'd be like, oh, I don't know. I don't know how to answer that. But today, it's a no-brainer. I'd stick it in there. I'd take the money out through a policy loan, and I would have just incrementally been paying it back or whatever I decided to do. But I'd be like, yeah, but I didn't give away that 20 grand. Mm-hmm. I borrowed somebody else's money, the insurance company's money, and the only real expense I have is the interest. As soon as I pay that off, then that was my only expense because it wasn't my money. My money was off in the premium deposit fund making money. My money's then going to go to work inside the policy starting in January. Gosh, like...
Good lesson, though.
Yeah, great lesson. Hopefully this is helpful. I think that what we want to do is just keep questioning how do we improve our practice of the infinite banking concept. And I'm grateful to be able to share this story, because I do think it'll be helpful.
Well, that was when we were talking before, and I said, John, we got to record it. Yeah. Because we were talking about that, and it was, hey, you got to talk about this on the episode. It's a great example.
Yeah.
And the way that the infinite banking concept is set up is actually really simple, but I'm constantly hearing of new ways that people utilize it that I'm like, wow, that's really smart, or that's really creative, or wow, okay, yeah, you can show that you actually saved a lot of money that way, or so I think it's good for people to hear things like that.
Cool.
I want to say too, I don't know if you agree with me on this. I think that if somebody has a surplus of cash, I would recommend that they be setting up another policy if that made sense.
Well, yeah, if it's going to be a steady thing, right?
Exactly.
Then
if they reach that next level of income and they qualify for it, they don't have too much insurance already, or their health is good, I would say getting another policy is ideal there. But there are a lot of people that maybe on paper they really can't have any more life insurance on them, or they have a health issue that's preventing the issuance of more policies. The PDF rider is a really good option for those that have paid up their policy and they have extra cash, and it also frees you up in the future to not have to pay that policy payment, which is really nice.
Yep.
So you if you came into cash one time, right, and you might not come into that again, to basically fill that up and know that you're set for the next 1 or 2 years it's a really nice thing. And again, it provides you a lot more freedom in those coming years. So
yeah, a lot of people are questioning, like, if I sell this piece of real estate and I end up with a check for $400,000, like maybe they had a second home, whatever, or investment property, what am I going to do with the money? And most people would stick it in the bank, right? And I'd say if you already have one of these policies, that's a one-time windfall, and take a portion of it or all of it, depending on what your premiums are, and put it into this deposit fund. They pay you basically an interest rate that's really...
It's market comparable, really.
It certainly is, and it's only going to help you in the future because it's going to pay these premiums, which is building the cash value, which then does this whole thing we've been talking about. So
yeah, and the last thing I'll mention, because this just popped in my head, and I won't go on like a big rabbit hole about this, but this was maybe more relevant a few months ago when everybody was, all hyped up about regional bank failures and whatnot. But we have some listeners that, are still worried about that, and John and I are still, on the slightly worried side about that. And another benefit, if you got a bunch of cash that you want to put somewhere for a year or two, an insurance company is a very safe place to put it. And so if you're somebody that's worried about the strength of some of the banking system there, you don't have to worry about the money when you put it in the PDF fund, because it's backed by the general the general account of the insurance company.
Yeah.
So
Yeah.
just wanted to kind of throw that last one in there. It's another kind of nice added benefit if you're somebody that's concerned about that.
Yeah. I mean, much safer place, honestly, because of the reserves, because of the dollar for dollar that insurance companies have set aside for your cash value and for your death benefit. Hey, it's much safer than putting it in some of these commercial banks. And I think we're going to see some trouble coming up. And, let's try to be smart and not store our excess income, cash flow, whatever, in these places. Use it for transactional stuff and create a policy that becomes your own banking system.
Amen. Love it. Well, if any of our listeners have any questions about this, reach out. We love talking about it.
Yep.
You got anything else, John?
Yeah, I just want to throw out at the end here, we talked a lot about, sort of writing reviews and so forth on the podcast, but if, following is basically subscribing so that you get notified when a new episode comes out. Actually, that will help us even more, I'm told. So, you don't have to take the time to, write up anything, even if you like us. You don't have to do that, but you can.
But we would like you to.
You certainly can. But
and we would be eternally grateful.
Yeah, but the follow would be great because I think that helps the algorithm get the word out and what we're trying to share. So if you find it valuable, we want to make it valuable to others, and hopefully you do too. Thanks.
Love it. Good stuff.
All right.
Well, until next week.
Yep.
All
until
right.
next time. Thanks, everyone.
Thanks.
Take care.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.